Welcome back to another edition of Intelligent Investment Today, the podcast dedicated to the art of value investment, as laid down by the father of the craft, the late great Benjamin Graham. Each episode is dedicated to a different principle of value investment, as spelt out in his books, The Intelligent Investor and Security Analysis. In today's episode, we shall examine the pros and cons of investing in businesses we know well and consider what Graham had to say about the matter. So settle down and get ready to absorb yet another key building block in your journey to becoming a better value investor. In today's episode, we shall be considering whether a close familiarity or a pre-existing relationship with a business in which you plan to invest improves or decreases your chances of investment success. It is certainly true that plenty of successful, high-profile investors are proponents of buying the stock of businesses they already have some sort of pre-existing relationship with. That relationship might take the form of being an employee or more often as a customer of a particular business. Proponents such as the American investor Peter Lynch was one such fan of the idea. He once bought stock of Dunkin' Donuts, such a fan was he of their coffee. Whilst this idea certainly seemed to work for him, where does it fit in with value investment, and what did Graham say on the subject? It is fair to say that on the whole, Graham was not a fan of the concept. Graham believed that while some familiarity with a business's operations was obviously a prerequisite before entering into any investment opportunity, an over-familiarity could, on the other hand, stymie rational judgment. For instance, if the opportunity arose for a person to buy a stake in their favourite sports team, it might be too much to expect of that person to analyse that business completely objectively when deciding whether or not to proceed with their investment. They will surely intrinsically be minded to place greater value on that team or club because of how they feel about it emotionally. Likewise, to a lesser extent, we can say the same thing about a business that the potential investor is a customer of. To use the Peter Lynch example, we may be enthused by a particular brand of coffee shop, convinced that if everyone else could see the light, they would be equally enamoured as they are. Perhaps the ultimate connection a potential investor is likely to have with a business is to be an employee of that business. On the surface, the familiarity the investor has with the company should be a positive thing. It is unlikely that anyone outside of the business has as much understanding of how that company operates than somebody on the inside who plays their part in operating it. This, you would think, would leave the would-be investor in good stead to profit from their superior knowledge of its operations. In reality, such investments don't always turn out quite as well as intended. The problem comes down to the same emotional bias as we discussed with the purchase of a favoured sports team. Sometimes when we're too close and too involved with an individual or entity, it can cloud our judgment to the realities on the ground. How often do you hear a neighbour or family member interviewed after a mass murderer has been convicted saying that he or she had always seemed such a nice person? They literally could not see what was standing right in front of them, and that often comes down to a failure of critical faculties when emotional attachments have been formed. As an aside, there are other considerations when considering the holding of stocks in a business by which you are employed. If the business was to struggle or to fail, then you may find yourself out of a job at the exact same time as your stock in the business has plummeted. So why then do two of the greatest investors of all time, in Lynch and Graham, differ so markedly in their opinion of buying stocks with which you are most familiar? This is simply because one is a growth investor and one is a value investor. Value investors are first and foremost interested in the results a business has achieved. They deal with hard facts and figures and are only interested secondarily in qualitative factors. That is, the aspects of a business that cannot be valued easily or definitively. An opinion of a business that is based upon close proximity may be valuable to a growth investor, but this is most definitely a qualitative factor, and in value investment, these factors are ones normally to be guarded against rather than profited from. In other words, as a growth investor, Lynch is looking to profit from future growth, whereas Graham was looking to profit from price discrepancies between what the stock is intrinsically worth and the price at which it is trading. This is not to say that an understanding of how a business operates is not of vital importance to the value investor. A business cannot be valued in any meaningful way if the analyst does not understand where the profits have come from. But this is very different to valuing a business based on some sort of insider knowledge that more often than not, in the end, boils down to mere personal opinion. A business like Walmart, say, can easily be understood by just about anyone. Essentially, it sells groceries. And for the value investor at least, they don't need to be a customer or an employee of the business to understand whether the stock should be bought or sold. For that information will be gleaned from the accounts of the business. It was for this reason that, unlike Lynch, who was a real proponent of getting to know the management team, believing that doing so would give him the insider track on the business, Graham, on the other hand, felt doing so was completely unnecessary. In fact, he thought that meeting the management team could actually have a negative impact on his judgment. A good connection with the management team, or alternatively a lack of any personal chemistry, in his opinion, could unfairly cloud his judgment on the business he was analysing. The investor Irving Kahn once quoted Graham as saying in reference to the meeting of managers of businesses, "So I meet the guy, and he has a moustache, and I don't like people with moustaches. It puts me off the scent. It confuses me." And this puts into a nutshell Graham's whole investment approach. There is stuff that matters when it comes to value investment, and there is stuff that doesn't. The risk is you allow the small stuff to muddy the waters, and this is where mistakes will occur for the value investor. Graham once said that investors should purchase stock like they purchase groceries, not like they purchase perfume. In other words, people are incredibly price sensitive when it comes to their weekly grocery shop. But if it's your favourite perfume, the price simply isn't relevant. When you have some form of emotional attachment to a business, then you can find yourself, if you're not careful, becoming like the purchaser of that perfume. In summary, the greater the understanding a person has of a business, the better, as this can only help them to make informed decisions when considering the purchase of that stock. This only really becomes a problem when that strong familiarity is created through emotional attachments to that business. These attachments may have come about through employment, as a simple fan of the business's products or services, or perhaps you play golf for the CEO. This over-familiarity can cloud judgment and create overconfidence in the prospects of a business and lead to misvaluations. Like the next-door neighbour who, when interviewed for the local TV channel, insists little Johnny always seems such a sweet boy, just after he'd been convicted of some serious crime, sometimes close proximity can hinder critical judgment. When we're talking about investing in what you know, in value investment terms at least, we're talking about the ability to understand thoroughly everything presented to us in the financial statements or accounts. There are plenty of businesses out there that are thoroughly understandable to the typical layman, like grocery or restaurant chains, or airline businesses. And then there are plenty that won't be understandable, such as banks, insurance companies or other financial institutions that require a more specialist set of skills to be able to accurately analyse. But some personal connection to a business is not required, and as we've seen, too close a proximity to a business can sometimes prove to the detriment of the value investor. That's it for today, folks. Thank you all for listening. I do hope you've enjoyed today's topic and now have in place one more building block that will add to your understanding of value investment, as laid down by Benjamin Graham. Please do consider subscribing if you haven't already done so, and continue to spread the word so we can make our community of like-minded investors as large as possible. Until next time, stay safe and happy investing.